Well, ladies and gentlemen, I think most of us are in the room. So good afternoon. My name is Rob Milner and I'm Chairman of Washington H. Pattinson, and I'd like to welcome you all to our 116th Annual General Meeting. I'm advised that there is a quorum present and therefore declare the meeting open. Before we proceed, I would just like to introduce you to our fellow directors and senior staff. Mr. Todd Barlow, our Managing Director. Ms. Tiffany Fuller, Non-Executive Director. Mr. Michael Hawker. Tom Milner. Mr. Warwick Negus. Rob Westphal. And down the end is David Gribben, our Chief Financial Officer. And on my right here, Ian Bloodworth, our Company Secretary. And in the front here we have John Gavalak, our Company Auditor. I would like to thank all representatives from our investee companies who were responsible for the stands in the foyer, and I hope you all enjoyed those and had a good walk around and talk to the various representatives from those companies. Just a couple of standing orders before we start. Mobile phones, I guess you've all got them turned off or on silent. There'll only be questions taken from shareholders or proxy holders. And when you stand up to ask a question, could you give me your name and tell me if you're a shareholder or a proxy holder? WHSP has a diversified portfolio of major investments as well as listed equities, private equities and direct property. WHSP is a conservative and value-driven investor focused on delivering returns over the long term. Through this approach, we have achieved the following over the last 15 years. Continually increased regular dividends, which have grown at a cumulative annual growth rate of 8.3%, and delivered a total shareholder return of 13% per annum, which is an outperformance against the All Ordinaries Index of 3.6%. The performance for the year ended the 31st of July was very pleasing. In fact, it was an outstanding result. The group recorded its higher ever regular profit of $331 million, an increase of 17% over the previous year. The value of the company's portfolio of investments grew by $972 million to $5.4 billion, an increase of some 22%. We increased regular dividends for the 18th consecutive year. The combination of the increase in the company's market value and the dividends paid added $1.1 billion value to shareholders during the year. Our total shareholder return for the year was 27.5%, outperforming the All Ordinaries Accumulated Index by over 12%. Now, the figures I've just given you were till the end of July, our financial year. Todd will give you some updated figures at the end of November, and I don't know whether you're all aware, but we've been extremely busy since the end of the year. TPG and Vodafone, the proposed merger, the ACCC is due to hand down their verdict next Thursday. Brickworks has just recently acquired a business in America, and New Hope now owns a minimum of 80% of Bengala, and Todd will give you a rundown on those new investments. The final dividend this year is 33 cents per share, fully franked, an increase of 3.1%. This brings total dividends for the year to 56 cents, an increase of 3.7%. The record date of the final dividend was 19th of November, and you'll all receive payment on Monday next week. This continues WHSP's exceptional history of paying dividends to shareholders. The company has not missed paying a dividend since listing in 1903, and WHSP is one of only two companies in the All Ordinaries Index to have increased regular dividend every year for the last 18 years. Dividends are declared based on the company's regular cash inflows less regular operating costs. This year, we will pay out 93% of net regular cash inflows from our operations. WHSP's diversified portfolio continues to deliver reliable cash returns, which enable it to provide increasing fully franked dividends to our shareholders. During the year, WHSP entered into an agreement to sell its head office building at 160 Pitt Street As a consequence, the company's last remaining pharmacy, which had operated out of that building for 145 years, ceased trading in May. In 2000, WHSP sold its pharmaceutical operations to API, and at today's date we still own just under 20% of API. The chemist in 160 Pitt Street was the only store retained by WHSP. This is an end of a chapter in the company's history. However, ultimately every asset is for sale at the right price, and the offer for the building was very compelling. It was sad to see the family close its doors, but we're immensely proud of what it has achieved. And then from the 1st of April, we're moving up into Clarence Street at the end of Barrack Street. We thank our many staff who have provided diligent service throughout the years and to our many loyal customers. And on that note, I'll hand over to Todd for his presentation.
Thank you, Chairman, and good afternoon, ladies and gentlemen. The Chairman provided an overview of the excellent FY18 results. What I'll do today is present an update on the portfolio as well as what's happened since the end of the year on 31 July 2018. It's been a fantastic start to FY19. The portfolio has performed extremely well in the last few months with strong share price growth across the major assets in TPG, New Hope and Brickworks. A lot of this has been driven by transactions which were announced and which I'll go through in a little bit more detail in my presentation. And this has driven a very strong share price performance in our shares for the year to 30 November. And as you can see in that table there, the 12-month total shareholder return has been near on 60%. While the short-term performance has been extremely strong, our focus is on delivering outperformance over the long term. And you can see from the table that we've delivered outperformance against every period. And over the last 15 years, the total shareholder return of 14.2% per annum is 5.1% greater than the average. Now, the effect of that outperformance year on year can be demonstrated by this graph where over 15 years an investment in Sols is up about 6.4 times, whereas that same investment in an investment that was correlated with the index would be up just 2.4 times. And those strong shareholder returns are not something that is a recent phenomenon. Over 40 years, the company has delivered a compound annual growth of 17.6% per annum, which means $1,000 invested 40 years ago would be now worth almost $650,000 today. This table represents a summary of our portfolio as at 30 November. The gross portfolio value is $5.8 billion, which is $386 million more than it was at 31 November. And this is during a period where the market has been very volatile, and in fact the index is down 10% in that period. I'll draw your attention to the listed equities portfolio, which is $472 million, as well as our cash and other net assets, which is $225 million. Together, we look at those two parts of our portfolio as being the liquidity that enables us to take advantage of new opportunities. Our listed equities portfolio is largely comprised of very liquid, large blue chip ASX companies, and our view is that we have a significant amount of liquidity and optionality to take advantage of new opportunities. Today, New Hope joined the ASX 200. The ASX 200 index is a list of companies compiled by S&P Dow Jones, and it's the 200 most investable companies on the ASX by size and liquidity. That brings the number of companies in our group that are in the ASX 200 to 5, and that's an extremely impressive result, particularly when you think about the hand that Sols has had in building out those businesses over time. Many of those businesses started as much smaller investments that we backed early and supported in their growth journey. And it's a fantastic achievement to see that 5 of the 200 top ASX companies in Australia have benefited from Sols ownership. One of the ways that we've been able to achieve this growth in our portfolio is through active M&A. M&A is at the heart of the way that we invest and the way that we add value. And here is a snapshot. It's a very detailed slide, so I won't go through it in detail, but starting with the merger of TPG with our business in 2008 and the sale of the New Saraji coal mine for $2.45 billion, you can see that over the last 10 years there's been a very active group activity across both acquisitions and disposals. And in that time, the value of Soul Pattinson has gone from less than $2 billion to over $6 billion today. So you can see that that M&A has actually been very value accretive for shareholders, and it's something that's going to be core to our strategy going forward. On the right-hand side there, there's been quite a lot of activity in the last 12 months, and actually a lot more of that activity in the last 4 or 5 months, which I'll go through in a little bit more detail. Starting with TPG, you can see that ever since the merger in 2008, there's been fantastic growth across all of the key financial metrics, although in the last few years, that growth has started to flatten out. And the reason for that growth diminishing is the impact of the NBN on broadband businesses. This is happening across the entire sector, and basically we're seeing the impact of the NBN reducing both revenues and margins as the NBN is evening the playing surface for all industry participants. So TPG had a very strong infrastructure footprint, which was replicated by the NBN. So the way that TPG has decided to combat that is to move into mobile, and you can see on this slide the rapid growth in the way that people consume data. And from a standing start, maybe 5 years ago, when smartphones were not capable of downloading a lot of data, to today, there's been a very significant growth. And in the last 12 months alone, the data downloaded on mobile devices is up 41%. So mobile is the natural way for TPG to diversify its earnings and grow its earnings, given its very strong infrastructure backbone. And the way to accelerate that entry into mobile was through the merger with Vodafone Australia, which I'm sure many of you would have heard about. It was a merger of equals, creating about a $14 or $15 billion market cap company. And if successful, WHSP will have 12.6% shareholding in the merged vehicle. TPG and Vodafone are highly complementary businesses with significant synergy potential. TPG, of course, is very strong in the broadband and has a very valuable fibre optic footprint which spans across Australia. And Vodafone is a mobile company with extensive mobile network assets. And it's worth pointing out that the valuation that we put on Vodafone in the merger is about $7 billion. And in the last 5 years alone, Vodafone has spent over $6 billion on its mobile infrastructure assets. The transaction requires approval from the ACCC, and we're hopeful of receiving that approval in the next week or so. And if the merger is approved, TPG shareholders will receive a special cash dividend prior to the transaction taking place, as well as a spin-off of the Singapore mobile business. We would expect the dividends to be a boost to our cash balance, which I think is a good opportunity for us to look for new opportunities in this more volatile market. In addition, the merged TPG will have a new dividend policy, which we think will enhance dividends to WHSP in future years. TPG is a multi-award winner, and on this screen are some of the awards that have been won just this year for customer service, service delivery and customer satisfaction. We believe that this is a really important slide because when you overlay this kind of customer experience with TPG's low costs and the combined infrastructure of Vodafone and TPG, we're very confident that TPG will be able to steal significant market share in the mobile market from Telstra and Optus. Looking now at Brickworks, as you know, Brickworks has a strong national business with manufacturing plants and display centres located in all states. In total, building products comprises 33 manufacturing plants and more than 27 display centres and design studios across the country. This is complemented by an extensive reseller network that includes over 100 additional displays. Brickworks' broad portfolio of products also provides diversification across market segments, including detached houses, multi-residential developments, and non-residential building. And to enhance that market profile, 2 weeks ago, Brickworks completed its acquisition of Glengarry, a US brick manufacturer, for $151 million. Like Austral Bricks, Glengarry is a company with a long and rich history in brickmaking dating back to 1890. Since that time, it has grown to become the 4th largest brick manufacturer in the US. It sells around 230 million bricks per annum. It's headquartered in Philadelphia and has a leading market position in that northeast and midwest region of the United States. We view the acquisition as providing an excellent beachhead into the US and a footprint for rapid growth. But Brickworks is much more than a building company. In addition to its building products division, it has extensive property assets, which generated $94 million in EBIT last year. The property assets have long leases to tenants and more development potential, which should continue to support earnings for Brickworks for many years to come. Of course, Brickworks also has a large shareholding in WHSP. Last week, Brickworks sold some shares in WHSP to fund the Glengarry acquisition, and that has reduced their shareholding from 42.7% to 39.4%. And this slide shows the growth in the value of the property portfolio as land is sold into the joint venture trust with Goodman and developed into industrial assets. The value of Brickworks' equity in the industrial property trust as at 31 July was $538 million. New Hope had a fantastic FY18 year, doubling the regular net profit from the previous year, and it also lifted the dividend by 33%. Coal prices remain extremely strong, and in addition to that, New Hope will lift its production as a result of the recently announced acquisitions. So just this month, New Hope closed the acquisition of an extra 30% of Bengala, which it acquired from Wesfarmers. And it has also agreed to buy a further 10% from Mitsui. So Bengala is the asset that you might recall New Hope bought an initial 40% from Rio about 3 years ago, a very well-timed acquisition. And what came with that acquisition was effectively an embedded right to buy further stakes in the joint venture should any of those joint venture participants want to sell. And that right enabled New Hope to be able to acquire that extra 40% at the same price that it acquired the first 40%, which was at the very low point of the coal cycle. So ultimately, we expect New Hope to have 80% of the Bengala coal mine, which currently produces about 9.5 million tonnes per annum of thermal coal. In November of this year, New Hope had a very positive decision in the Land Court of Queensland, which recommended the approval of the Stage 3 expansion of the Acland coal mine. The next steps are to go through the remaining Queensland state-based approvals. However, the Land Court decision was a very important and positive development. New Hope remains committed to and is optimistic about ensuring continuous operations and securing the jobs of 300 employees and 500 contractors in the community. For this to happen, we will need approvals in mid-2019. Over the last 10 years, New Hope has distributed over $1.9 billion of fully franked dividends to shareholders. This is often lost on people, or they receive a dividend and they forget about it the next year, and people often look at share price histories and they don't take into account the very significant dividends that have been paid. On a per share basis, that $1.9 billion is about $2.30 per share. So shareholders have benefited very well from high dividends over the last 10 years, and we're starting to see some very strong production and profits which will support dividends in the future. We continue to believe in the long-term need and demand for coal. There's currently over 1,000 coal-fired power plants that are either under construction or in the planning stages in the world. Many of those, or in fact most of those, are in the Asian region, which is the region where Australia sells its coal and where New Hope's customers are. And this slide probably best demonstrates where that growth in the coal demand is coming from. If you look at the bottom countries of that graph, Taiwan, Japan and China are all relatively flat over the next 10 years. They're very mature markets and not growing, but there's some quite significant growth coming from Southeast Asian markets and India. And what we're seeing is no supply response in the market. So despite very high coal prices, there's no new coal mines of any significant size being added in the world. So we think that that will be a very positive thing for coal prices in the future. Similar to coal some years ago, we see the same dynamics being played out in copper, and our business Copperchem has been renamed Round Oak Minerals to better reflect that this is now a diversified company with interest in copper, zinc and gold and some other base metals. In recent times, over the last 12 or 18 months, Round Oak has added two significant assets, the Jaguar mine in Western Australia and the Stockman project in Victoria. There's currently a mix of assets in development and operating mines. However, over the next 18 months or so, we expect to see all of those projects in production. And the reason why I said that we see copper as in a similar situation where coal was a couple of years ago, we've seen the copper price fall in recent times. However, if you project out a few years, you can see that there's a projection, and that's a Rio Tinto graph there on the left. There's a projection for a very significant supply shortage across the globe. So demand we expect to continue from things like electric vehicles, renewable energy, all big consumers of copper. But the existing copper supply globally is set to fall, which will create pricing pressure. So Citigroup's analysis is indicating a very significant increase in copper prices going forward. Last year we had a question on WHSP's technology investments and our approach to technology investing. And we see technology as something that can't be ignored. It's becoming a bigger part of the universe of companies to invest in. And we also see that rapid changes in technology present both a risk to existing businesses and also an opportunity to invest. We've always been a successful technology investor and been invested in technology businesses for some time. The biggest asset in the portfolio, of course, is TPG, which started life as SP Telemedia, and that was a wholly owned business of WHSP. Over time, we added various businesses, and today, TPG is one of Australia's biggest telecommunications businesses. We identified early the growing demand for data consumption, and that continues to be a very strong theme today. We also have a variety of other technology investments across the portfolio, and our approach to technology investing is to find businesses that have established business models which have unique technological advantages or are beneficiaries of technological change. And there's a snapshot there of the various entities that we currently have some investment in, and all of them I think are quite exciting opportunities. So finally, I just wanted to outline what we provide to our shareholders, and it's the 4 Ds. We are disciplined, we deliver, we provide dividends, and we have a defensive portfolio. We're disciplined in the sense that we take a long-term approach to investing. We are often contrarian. Taking our best investments are those that occur when everybody is running in a different direction. We're conservative and cost-conscious with our investments, and we instill that discipline on our investee companies. I hope I've been able to demonstrate today through some of the earlier graphs the long history of outperformance, which we've done in a way that is lower volatility and lower risk. We haven't taken on excessive gearing. We haven't bet the house on any one particular investment. Dividends, we're very proud of the fact that there's only 2 companies in the All Ordinaries Index that have been able to pay a higher dividend every year since the year 2000. And our diversified portfolio provides a high level of security to our ability to pay those dividends. And finally, the defensive nature of our portfolio, I think, is very important, particularly as we move into this more volatile part of the market cycle. Our portfolio should generally provide more certain and more secure returns when the rest of the market is falling, because we deliberately geared towards investments that perform no matter what happens in the economic cycle. So if you look at TPG as an example, it performs like a utility. People are always going to consume mobile and broadband subscriptions no matter what happens in the business cycle. Coal is generally uncorrelated with the economic cycle, and certainly was in 2008 when the rest of the market was falling. And Brickworks, as I pointed out, is a company whose reliance on the economic cycle in building products is much lower than people think. They have very long-term assets with the property portfolio, and of course they have a very big investment in us. So we actually think that Brickworks is quite a defensive company as well. So with that, I'll finish and invite any questions.